All right, folks, welcome to Investing for Beginners podcast. We just created a fun email series about 5 habits that you can use to help master the investment process. And today we thought we would cover 2 of them. One's going to be more veggies and the other one will be more of an entree. We'll start with the veggies first, and we're going to talk about risks and how to handle risks. And Andrew is the master of this, so I'm going to throw it over to Sir Andrew and we'll go ahead and start.
Yeah, thanks. We picked the very most fun.
Yes, exactly.
Most easily shared. Gonna have a coffee and just talk about risks all day long with all your stock picking friends.
Scintillating.
I'll give maybe a quick backdrop of why it's important. And if you've been in the market a while, you already know this. But if you're a beginner, this might be a little bit profound for you. So the way that stock market works. Let's start with the GOAT. The GOAT, Warren Buffett, he says he has 2 rules to investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And the reason why that's so important in the stock market world is because when you lose money, it's hard to make that back up. And that just kind of is what it comes down to. And that's because the numbers behind it are not intuitive. The math behind losses is hard, and it becomes harder to make up losses. And this is why we want to respect risks and try to stay away from them in the stock market. We talked about my Carnival cruise ships disaster the other day, one of the previous episodes on this show. And I remember when that one went down, I think it was like a 60%, 65% loss, something like that. And so you hear that number and you think, oh, okay, you lose 65, you got to gain 65. But actually, a loss of 65 is going from 100 to 35. So if you think about 35, how do you get from 35 back to 100? You can't just make 60% on 35. You have to not only double it, but almost triple your money just to get back to that 100. And so it takes sometimes living through that and seeing your broker account or seeing the stocks in your account go so low to realize like, wow, when you lose money, you have to make it up that much more. And it's rare for stocks to do that. Now they do that, and you do get like the rubber band effect and, extreme pessimism and things like that. But when you go from a stock that was perpetually loved, adored, like roll out the red carpet for this stock, and then they are no longer like that and they're treated more like a regular business, you've lost all that money that you had in the stock and you probably won't gain it back for a long time. And that's why it's important. It's not fun to talk about. It doesn't win you Oscars or Academy Awards, but it can help you preserve your wealth. And as you preserve your wealth, you can compound it over time. It's a lot easier to compound if you're earning 10% on 10% on 10% versus losing 3/4 of your wealth. And then now you're trying to triple, quadruple, 10x your money just to get back to even. It's a much harder road to go up when you play that game versus playing the Warren Buffett kind of safe way.
Yeah, for sure. And those are great examples. And if you look at financial literature, there are lots of different people saying roughly the same thing in maybe different ways. Like Howard Marks loves to talk about protecting his downside risk. And if you think about Howard Marks, he's probably one of the more conservative investors out there. And he spends a lot of time thinking about how can he avoid exactly what you're talking about. And that's kind of his style of investing. And Monish Pabrai, one of our favorites, always talks about heads I win, tails I don't lose that much. It's kind of the same idea. Like you're trying to protect losses against losses and trying to avoid those big downturns because, as you said, the math can sometimes be quite daunting. And it's not unusual for companies to drop, especially when Dave invests in them. And so it is something to keep in mind. But to your point, when you see a 65, 75, 85% drop, to return back to air quote even, just even, is a Herculean effort. And that's a lot of times why it's probably best in those circumstances to just cut your losses and sell, because the energy that's going to be required and the stress that it puts on you seeing something like that in a portfolio could affect other decisions down the road. And so that's something to consider as well. I was actually just reading, I was kind of going through Reddit the other day, and I was looking at some comments, and one person was talking about that very fact that they left a stock that they had bought, which was down 92% or some crazy number like that. And they are leaving it in their portfolio as a reminder of the stupidity of why they bought that company. And so it was like a road map, or a red flag or a black flag for the skiing, just to remind you, hey, don't do this again. And that's actually not a bad idea. But I'm not wishing that on anybody, but I'm just saying it's not a horrible idea. But it is interesting how there are lots of great investors that talk about the protection of the downside loss and trying to avoid making big mistakes in the market. And that's one way you can be successful, is by avoiding the big losses and trying to swing for the home run every single time. If you want to do it once in a while, fine, scratch that itch. But if you're doing that consistently and you see a lot of companies that are down 70, 80, 90%, you might want to ask, is this the right way for me to invest?
Totally. Yep.
So how do you think about risk, and how do you structure your portfolio and your stock picking ideas to kind of stay in this lane, so to speak?
There's several types of risks, and I'll try to touch on all of them without diving too deep into it. But you have the most obvious risk, which is the risk that a company goes bankrupt, or the risk that they run out of money. And then maybe they don't go bankrupt, but as a consequence of running out of money, they have to do things that are not great for the stock price. Like they have to issue debt at a really high interest rate, or they have to issue equity, and that makes your slice of the pie smaller, which makes the stock price go down, by the way. So that's like the first bucket to try to avoid. And you do that by looking at the balance sheet and the debt situation, liquidity, solvency, things like that. The next risk that I think is prudent to look at is the risk of competition. And that kind of ties in with looking at the moat, but it's also, I think it helps if you approach it from a risk-based perspective, because you can have industries, and I mean, there's countless examples littering business world history of businesses where an industry grows, it all goes to one business and the rest of them get the scraps. And it's not pretty if you're in one of those businesses that didn't have a moat. And then the last risk would be like a valuation risk, where the business could do great and they could be one of the best businesses from a growth perspective, but the stock price doesn't get that growth because it was just bid so outrageously high. It was adored, it was loved, they rolled out the red carpet for it. And there's plenty of examples of that too. For me, my favorite one was the whole .com boom and bust, and a company like Cisco, who the stock price went so ridiculously high that after it came down to earth, I still don't think the stock has recovered, which is crazy, from its 1999 peak. And what was crazier to me is like everything they said about Cisco ended up being true. It was going to be the backbone of the internet. Everybody was going to need Ethernet and routers and all those things. And that all happened. And the company went from like, I don't know if it was like hundreds of millions, maybe a couple billion, to like tens of billions, 40 billion, 50 billion. I'm talking about sales. And yet the stock price you didn't see that same thing because the valuation was just too bad. So those would be the three main buckets I try to focus on when I look at a company and kind of try to tear it apart, because easy to get excited about a company, but much better if you can throw your idea through the fire and get it refined until you realize if you have a really good idea or not.
Yeah, exactly right. So how do you put it through the fire? Like if you come up with an idea, how does Andrew, mold it through the fire?
The easiest shortcut would be to read the annual report kind of backwards and start at the risk factors. Annual report being broken down into different sections. Some companies do, but generally you don't see risk factors first. You usually see flowery language about why a business is so wonderful. If you can skip that, if you know a bare minimum enough about the business that you can understand some of the risk factors, then just start there, because to me that saves a lot of time. And risk factors are hard to read because a lot of them sound the same and a lot of them are the same. So it just takes experience and practice to be able to discern what parts you can skip, what parts you can skim, and what parts you have to read deeply. But you'll be shocked by how much information. Sometimes I learn more about a business in the risk factors than I do actually in the business description, because things like who's their biggest customers, what percent do those customers make up? Is it 10 customers making up 55% of sales? Then that's a good indicator, because it's a risk, but it's also just an inherent feature of the business. And then even things like, yes, you have these metrics which you can use to analyze debt, but sometimes if a company's debt is that concerning, they will put it in the risk factor and you can just see it right there and then. It's like, oh, okay, this might be a riskier investment from a balance sheet perspective. So all of those things can be found in the risk factors, and it's not fun, and it's just one of those kind of like making your bed. You don't want to do it, but if you do it, it's probably going to be good for you.
Yeah, exactly. And the interesting thing is, you've heard, most people have probably heard this term, the details are in the fine print. And I always think of this as the fine print. Like this is the part that you necessarily, like you said, it's not fun. And some companies are better than others. A bank is an experience. So we'll just leave it at that. But yeah, to your point, you can find so much little nuggets in there that they don't really talk much about in other places, but because lawyers are helping write the 10K and particularly this section to cover everybody's booty, you will find little things in there that you're like, oh, I did not know that. That is very interesting. And sometimes it can be great. Like sometimes it can actually make your idea or your thesis about the company even better. And sometimes it can save you a lot of heartache, because you're like, ooh, okay, yeah, that's real bad. I'm out here. And so it's definitely a good place to hunt for hidden treasure, is in that section, because there are lots of little nuggets that they're going to have to reveal, and that is the place that they will reveal it, and in the hopes that sometimes people won't read it, I'm sure. But I know you do. I know that's one of your, not necessarily your favorite section, but I know it's definitely a place you mine to make sure that you're protecting the downside.
Yeah, totally. Another technique I will borrow from a guy named Dave Ahern, this idea that as you're reading the annual report, maybe we're past the risk factors now, we're going to the other pieces, to write a list of questions that pop into your head as you read. And particularly if those questions skew a little more on the skeptical side, that can be a great way to uncover risks. The thing about finding risks is that there isn't like a easy checklist. It's not like inspecting a fighter jet. You can't just go through the checklist and you've covered all your bases. Business can be rotten for many different reasons. And as an investor, it's your job to try to uncover those cases where there's something glaring. Hey, there's businesses all the time where things are glaring and the company grows out through it, and that's fine, right? You still make money that way, obviously, but hopefully, as an investor, you want to improve your skills so that you are putting yourself in the best scenarios that you can with the best chances, getting good at identifying those things, being maybe a little more persistent, and just being curious in general, I think is a great way to do it. Because if you just assume, oh, the business is like this, so I know the business is going to do that, you're going to miss out on a lot. And you can miss out on the upside, but also you can miss out on the downside, and that can be very dangerous.
Yes, very dangerous. And I think if you know the company, let's say it's a product that you use on a regular basis, I would I would definitely make sure that you read through the risk sections and think about those ideas, because I think it would be real easy to let our bias creep in that circumstance. Like, oh, I love this company, or I love this product, or I love the CEO, or I love this about the company, and just kind of skim through it and not pay attention. And to your point, then you are kind of setting yourself up, could be setting yourself up for some pain in the future if you don't pay attention to what's going on with those circumstances. And the way I try to look at it, I read it somewhere, I'm sure, that you're trying to get to a no as fast as you can. You want to find a reason not to buy the company. And because if you can get past that hurdle, then there's a pretty good chance that you're finding a pretty good business to invest in. And the other thing is, we don't have to swing at every pitch. So just because you sit down to read the 10K and commit time to that, it's not a sunk cost. And it could just be that right now the company's going through something that just isn't a good fit for you, and it's okay to move on from there. But just remember, you don't, just because you sit down to read a business's prospectus and their 10K and all the other financials, and you decide, nah, that it's not a lost cause. It is compounding knowledge that you can put to use for further businesses as you go forward with your analysis. So the more reps you put in, the better you're going to get at it.
Compounding knowledge.
Yes.
That's what it is.
Yes. Yes. All right. So maybe we can segue to the entree portion of today's show, and we could talk about valuation. This is far more fun. So I guess, what are your thoughts on valuation? And I'm not saying risk isn't important. I'm just saying valuation is more fun. At least it is to me.
Yeah.
Yeah, I think you would agree. So let's talk about valuation. What is that to you, and how should investors try to think about this?
Yeah. A million different ways you can think about valuation. Hopefully, if you take nothing else away from the valuation piece, understand that, and again, this is obvious if you've been doing this a while, but you are allowed to pay more for something if it ends up growing at a faster rate than the average. And so again, there's math behind it, but basically you have a high enough growth rate that even if a stock price comes down because it was too expensive, that growth rate is high enough, then you've made up for that difference and you've actually got a really sweet return. To quote Buffett or Munger, something to the effect of, if a business has a return of 6% or grows at 6% a year over the very long term, you're going to get 6% return on that stock. Same case if it grows 8%, 10%, 12%. Over the very long term, that valuation difference tends to kind of cancel out. So you can kind of use that as an argument to say, well, valuation doesn't matter then, because I'm just going to buy things for the long term. And that's true, but my batting average is not quite 100%. So I have to account for that by looking at valuation, because not 100% of the stocks I buy are going to have that nice long-term growth rate that you see all the winners do. So the important thing is, to me, if you want to have a margin of safety with the stocks you buy, it's not just about buying it cheap when it looks cheap, but it's also, if it's a business that's kind of like a higher tier growth business, making sure that you are being conservative enough with the growth estimate. I think the growth estimate is where you can run and basically make any valuation up that you want. That growth estimate is really the big piece there. So if you have a home base of more conservative growth estimates, then over the long term, on average, you're going to undershoot. You're going to be more conservative. You're going to make less mistakes in valuation. If you have a habit of, I'm going to project 15% growth for every stock that happens to catch my eye and I think looks attractive, you're probably going to make more mistakes. And so having that base level, Michael Mosen calls it base rates, but having just these reasonable expectations on how much you think a company will grow will help you go a long way towards building a habit of finding stocks that are undervalued.
Yeah, exactly. I think what Charlie said, I think was so profound. And if you think about the kinds of returns that you're looking for, you don't have to go hunting for the most expensive or the highest growers to get the kind of returns that you want. If you look at Warren Buffett's returns, he's over a 60-year career, 19.9%, 20%. What I've seen different numbers thrown around. Outstanding returns, unquestionably. The majority of his money is in Berkshire Hathaway, the company that he owns, and that is not a high growth, high flying kind of company. And the companies that he buys and invests in kind of fit into the same pattern. He looks for companies that have good growth prospects and that he can get at a good price. It's calculus. It's not easy to do, but it's a simple calculus. And if you think about anything that we buy, I always like to use this analogy: shoes, cars, a home, guitar, a bottle of wine, a hamburger. We all want a deal. We all want to find something that we think has a lot of value and pay less for it, because then we feel like we're getting more for our bang for our buck. And why we do all that and not apply the same idea to investing baffles me. And for whatever reason, those two ideas don't always meet at the door when people walk into the stock market. And so this idea of trying to find companies that you can get a really good business and pay a decent price for, but has a lot more value that it can generate for you while you're holding on to that company, is really what it comes down to. And there are lots of roads to Rome, right? And there's lots of different ways to do this. And like Andrew said, you have different choices of what kinds of companies you want to invest in, and you have different tools that you can use to help you try to assess the value of that particular business. But we always have to keep in mind that there is one big thing that will always cause challenges when we're valuing companies, and that's our own biases. How we think about companies and what we think about different things, it's going to creep in. And so I love what Andrew was talking about, like using base rates and trying to be as conservative as you possibly can, because that's a natural built-in margin of safety. It's super easy to look at NVIDIA and go, yeah, they're going to grow at whatever crazy rates they're growing at right now in perpetuity. History tells us it won't happen. And I'm not trying to be Debbie Downer. When is it going to stop? I have no idea. It could happen for the next 14 years, but it's not going to last forever. It won't. And so having said that, you have to, if you want to buy NVIDIA, you have to figure out how to value it. And you can't put that growth rate on the company that it's doing right now forever, because that's never happened and it's not going to happen. And so you have to guard against drinking the Kool-Aid, I guess, is the easiest way to say it. And who here, raise their hands, me, has read, got excited about a company, you drink the Kool-Aid and you think it's worth way more than it is. It's like going to buy a car. You fall in love with a car at the dealership and they're telling you that it's worth $60,000 and it's only worth $40,000, but you pay $60,000 because you fall in love with the car, and the car dealer, the person working there, is good at what they do. And so anyway, long story short, I think we need to make sure that we check our biases at the door. And that's one of the biggest things. The math is math. You can figure out how to plug in the numbers. It's a matter of checking your bias at the door, and using what Andrew was talking about is one of the best ways to try to be conservative, to help check your bias at the door, because that's going to save you a lot of pain in the end.
Yeah, for sure. And I think the piece you said about NVIDIA, that's such a powerful thing to try to internalize. And it's so hard to do, because it's really easy to just kind of take the trend and say, okay, this is what it's been the last year, 2 years, 3 years. And so we're just going to project that forward. And, I heard an earnings call where the CEO basically did that exact same thing. But anyway, like, that's easy for us as investors to do, but it's not always the best thing to do, because past performance doesn't guarantee future results, and the future does not always happen just like the past was. So when you look at valuation, it's not something that you silo as its own separate thing. It should incorporate every habit that you've built into the stock analysis process, because it's not as simple as just taking the past and extrapolating it to the future.
Yeah, exactly. And to your point earlier, it's incorporating the risks of investing in this business as part of the valuation, and that is all part of the piece of the pie or the pizza that you have to incorporate. It's not just all the yummy stuff like the cheese and the pepperoni and the sausage. You got to include the dough, and you got to include the sauce that you put on there as well. And so all those ingredients go into making, a delicious pizza, just like it goes into making a fantastic investment. You have to incorporate all those different aspects to make sure that you're not only covering your bases, but also trying to encompass the whole idea of what it is you're trying to buy. And I hate to keep coming back to the whole bias thing, but it's something that I think gets overlooked a lot and doesn't get discussed enough. And to your point about the history of looking at these companies and trying to, it's great that they've done so great in the past and projecting that forward. And I go back to Warren Buffett again. He has been investing for 60 years. He has bought probably some of the best businesses out there. And during these high flying periods that the markets have experienced, the dot-com boom, for example, he wasn't buying those high-flying businesses. He was buying things like Coca-Cola and Colgate and Gillette and Dairy Queen and all these solid, great businesses that have done really, really well for him for a long period of time. And he got ridiculed along the way because he wasn't partaking. Oh, Buffett's lost it. Oh, he doesn't know what he's doing. Time has passed the old guy by. All those different things have been said about him during those periods, and that has proven not to be the case. And so it's real easy to get blinded by the new shiny object or whatever is going on great right now. It doesn't mean that it won't last for a long time. It also doesn't mean that it will be a short-lived event either. I think the biggest thing is just stay consistent, stay conservative, margin of safety. All those things will do well for you as you continue to go forward. And I think if you remember all those things, I think you'll end up with a really good result, as Charlie would say.
Yeah. And it's funny, the whole FANG thing, right?
Right.
Kind of going to like this chasing what FANG happened. It was Facebook. Was it Apple or Amazon?
I think it was Apple. I think it was both, actually, Apple and
one.
Amazon.
Yeah.
Netflix.
I can't remember who
Google.
the original A was.
Right.
Netflix
I don't
and
either.
Google.
Yeah.
I remember it was just probably 3-4 years ago, 5 years ago. I was telling myself the FANG was so obvious in hindsight. The next FANG that happens, I'm going to make sure I'm all over that. And I'm going to keep an eye out this time. And guess what? It's happened. It's AI, it's NVIDIA, it's Broadcom. And I missed it again. And so there's something about that. Like doing that twice now makes me realize that, yeah, investing in kind of the Buffett way, the safer way, the tried and true way is a lot easier and a lot more, like the chances of me being able to find good businesses like a Gillette or a Coca-Cola or an Apple after they've already done well for a long time, that's an easier road than trying to find the next FANG or the next AI or the next whatever hot stock there will be, because it's just easy to trick ourselves into thinking that we can be that person to find it. But I'll tell you, like, it's not that simple. I don't care how many years of experience in the market you have. It's just not that simple.
No, it really isn't. I agree. All right. So we've kind of talked about the philosophy of valuation and how you should really think about it and structure your thought process about it. Maybe what are some of the methods that you like to utilize or you think would be helpful for investors to consider or use?
I'll give a beginner and then a beginner intermediate, and then like a more advanced. So beginner is just the price to earnings ratio. That one's all over the place. You can learn it It's not super hard to grasp. Taking the next step from the PE ratio would be like the PEG ratio. This was something that Peter Lynch has talked about before. And if you break down the DCF, it's pretty close. It's very similar. The math is way less complex. It's a very similar concept to the PEG ratio. So basically what you're doing is you're comparing the PE ratio, you're looking at the growth rate, and then you're using that to compare two companies. So for example, throw out an old fuddy-duddy company that's not growing anymore.
How about IBM?
Okay. IBM, and then let's take Google, for example. If IBM was a very low price earnings and Google was a much higher, you would probably say, oh, from a PE, Google is more expensive. But if you're to incorporate growth and you see that Google is growing that much more, you can use the PEG to kind of give you context on is the higher grower still more expensive, or relative to its growth, is it actually cheaper? And I think that's a great tool, and I think it's underutilized and not talked about enough. And it's way simpler than trying to learn a DCF. I would combine a PEG ratio with base rates. Go read Michael Mobison's masterpiece on base rates, and I think you'll do way better as an investor. If you're trying to go hardcore, you're trying to go all the way, try cutting your teeth on the DCF. Oswald Damodaran has free DCF courses on YouTube. He also has free spreadsheets. Take advantage of free resources. You know, you can definitely make mistakes yourself, but why not learn from somebody who's gone down the path before you as well? So invest that little bit of time to try to learn the DCF, and understand that learning the DCF is going to be even more like learning a language. I remember many afternoon calls, caffeinated, filled with you, Dave, where we were just like, why? Like we were trying to figure out why is this like that, and you know, we were just banging our heads on it. But eventually, it made sense. Just keep pushing, and yeah, those would be the methods.
Yep, I would 100% back all three of those. I think those are great evolutions for people to start. The PE ratio, then the PEG ratio or the PEG ratio, and then a DCF. And it can help you value pretty much any type of business out there, and at different levels or different stages of the business. And so it can be very, very helpful to utilize those as a way to start to value companies. And it really doesn't matter per se which one you choose. The big thing is just making sure that you're consistent with your estimates, and make sure that you continue to just try to learn from the valuation. It's like any other skill. You got to put in the reps. You can't just sit down one day and go, hey, I got this. No, it's a little more challenging than that. And understand that you will make mistakes. You will get things wrong, and that's okay. The bigger issue is just trying to make sure you learn from those mistakes and continue to try to evolve. And I second Oswald Damodaran's classes. That's really kind of how I cut my teeth on it. And he's a great teacher. He's been doing it for a long time, and he's really good at it. And you can learn a lot from him, and Michael Mobison as well. His papers are fantastic. He's a very good teacher as well.
And if you're trying to kind of get the holistic viewpoint on valuation, kind of like what we were talking about before, you know, valuation should be influenced by all the other things you know about a business, then check out the other 3 habits. You know, einvestingforbeginners.com/habits. We've done the email series for you. Valuation is a piece, risk factors are a piece. There are 3 other important habits. Implement those into your stock picking process, and I feel really good that you're going to get way better at what you do.
All right, folks. Well, with that, we will go ahead and wrap up for today's show. If you really enjoyed hearing what we were talking about with the habits, you will find a link in the show notes that you can go and sign up. It is for free. It's a 6-day email series that you'll get 1 email each day. And I'm not going to tell you what it is, but there are a surprise or 2 in there for you as well. And so I think you'll enjoy it, and you'll also learn something along the way, and what could be better than that. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.